1. Understanding market making. To begin, it's crucial to grasp the role of market makers in the financial markets. Market makers are financial institutions or individuals that continuously provide buy and sell quotes for financial instruments, such as stocks or currencies. They profit from the bid-ask spread, buying at the bid price and selling at the ask price. Their primary goal is to facilitate trading by providing liquidity to the market, ensuring there are always buyers and sellers available. By understanding this role, scalpers can anticipate market maker behavior and utilize it to their advantage. Here are 5 lesser-known tips about market making. The art of flipping. Market makers go beyond simply quoting bid and ask prices. They can also employ a strategy known as flipping. This involves rapidly buying and selling the same asset at slightly different prices, capitalizing on micro-price movements. This strategy requires high-speed execution and a deep understanding of market fluctuations. Impact of announcements on market makers. Significant announcements, such as corporate earnings or major economic events, can disrupt market maker activities. They may temporarily widen the spread between bid and ask prices to shield against increased volatility. Informed traders can capitalize on these moments to negotiate more favorable spreads. Hidden order management. Market makers often use hidden orders to conceal their true intent in the market. These orders are not visible on the public order book, potentially misleading other traders. By closely monitoring order book movements and detecting execution patterns, traders can attempt to anticipate the actions of market makers. Instrument selection. Not all financial instruments are equal for market makers. Some assets have narrower spreads and higher liquidity, making them more attractive. Seasoned market makers carefully choose the instruments they focus on based on their expertise and potential profitability. Risk management. Market making comes with significant risks, particularly related to sudden market volatility. Professional market makers implement sophisticated risk management mechanisms to limit losses. This can involve using advanced trading algorithms, diversifying assets, and constantly monitoring the market for warning signals. These tips delve beyond the basics of market making and can assist traders in developing more advanced strategies in this field. 2. Volume price impact analysis. Volume price impact analysis involves studying how the trading volume affects the price of an asset. This analysis helps identify price levels where large trades are likely to cause significant price movements. For example, if a substantial volume of buy orders is executed at a specific price level, it may indicate strong demand, causing the price to rise. Conversely, large sell orders at a particular level can lead to price declines. Let's delve into the details of how to integrate each of these order flow-based tactics techniques into your scalping strategy. 1. Order book analysis. To integrate this into your scalping strategy, watch for order book imbalances near key support or resistance levels. Look for a sudden shift in the quantity of buy or sell orders. If the order book rapidly changes from showing strong buying interest to a balanced book, consider it a signal to fade the breakout. 2. Depth of market DOM data. Utilize DOM data to identify imbalances in the order book, paying particular attention to the price levels near your breakout points. If you see a significant change in the depth of market data, it may indicate a false breakout. 3. Volume profile. Integrate volume profile by analyzing where the majority of trading volume occurs during breakout attempts. If you notice that the highest volume is concentrated near the breakout level and quickly reverts, consider fading the breakout. 4. Liquidity traps. Keep an eye on visible liquidity traps in the order book, where large orders are stacked above or below the breakout level. If the price touches these traps and reverses immediately, it's a sign to fade the breakout. 5 Iceberg orders. Watch for iceberg orders by observing how visible orders interact with hidden large orders within the order book. If a visible order gets absorbed by a hidden iceberg order and the price reverses, it's an opportunity to fade the breakout. 6 Time and sales data. Incorporate time and sales data by monitoring the trade-by-trade breakdown of executed orders. Look for clusters of small trades in the opposite direction of the breakout. These clusters can suggest a reversal is imminent. 7 Stop hunting. Be vigilant for signs of stop hunting by larger market players. If the price briefly pierces a critical support or resistance level to trigger stops and then rapidly reverses, consider fading the breakout. 8 Market depth heat map. Use a market depth heat map to visualize order flow. Pay attention to abrupt changes in the heat map near your breakout levels. Sudden shifts in supply and demand patterns can signal a false breakout. 9 Volume delta. Calculate the volume delta, which measures the net buying or selling volume at each price level. Look for a significant negative volume delta after a breakout attempt. If the selling volume outweighs buying volume, it suggests a false move. 10 Cumulative delta. Monitor the cumulative delta over time, keeping an eye out for divergences between the price movement and cumulative delta. If cumulative delta fails to confirm the breakout, it could be a sign of a false move. Incorporating these order flow-based tactics into your scalping strategy requires constant monitoring of order book data, volume, and trade execution. Use these techniques as additional confirmation tools to validate potential false breakouts. Remember to practice disciplined risk management and avoid chasing trends when employing these strategies in fast-paced scalping scenarios. 3 Identify key price levels. Based on your volume price impact analysis, pinpoint key price levels where market makers are likely to step in. These levels are typically situated near the current market price and are potential points of interest for scalpers. For instance, if you're trading a stock and notice that a significant volume of orders is concentrated just above the current price, this level becomes a key price level to watch. Let's break down the process of confirming liquidity traps into 12 key steps with descriptions, numbers, and examples. Step 1. Identify potential liquidity traps. Begin by identifying potential liquidity traps on your price chart. These traps often appear as visible stacks of buy or sell orders above or below significant support or resistance levels. For example, if you're trading your USD, you might notice a stack of sell orders just below a key resistance level at 1.2000. Step 2. Mark the key support or resistance level. Mark the specific support or resistance level where the liquidity trap is positioned. This level should be based on sound technical analysis and should be a level that traders are closely watching. Step 3. Observe price approach. Watch how the price approaches the identified support or resistance level. In the case of a liquidity trap above resistance, you'll see the price rising towards the resistance level. Step 4. Liquidity trap trigger. When the price reaches the liquidity trap, observe the price action closely. The key confirmation here is if the price briefly touches the trap, the stack of orders, and then rapidly reverses in the opposite direction. The rapid reversal is a strong indication that the liquidity trap has been triggered. Step 5. Confirmation candlestick. Look for a specific candlestick pattern that confirms the liquidity trap setup. For instance, a long upper shadow on a bullish candle or a long lower shadow on a bearish candle after the trap is touched can provide additional confirmation. Step 6. Volume spike. Check if there is a significant spike in trading volume as the price touches the liquidity trap. High volume at this point supports the idea of trapped traders being flushed out of their positions. Step 7. Percentage movement. Measure the percentage movement from the trap level to the point where the reversal occurs. Typically, a rapid reversal within a short distance from the trap is a strong confirmation. Step 8, Example Scenario, Short Liquidity Trap. Let's say you're trading crude oil CL and notice a stack of sell orders just below a key resistance level at 75.00. As the price approaches 75.00, it briefly touches the stack of sell orders, but within seconds, it rapidly drops to 74.50. This rapid drop of 50 cents is a strong confirmation of the short liquidity trap. Step 9, Example Scenario, Long Liquidity Trap. In another scenario, you're trading gold XAU/USD and spot a stack of buy orders just above a support level at 1800.00. As the price nears 1800.00, it briefly touches the stack of buy orders but then surges to 1805.00 rapidly. This quick 5.00 upward movement confirms a long liquidity trap. Step 10, Multiple Confirmations. Look for multiple confirmations to strengthen the validity of the liquidity trap setup. Confirmations can come from additional technical indicators, patterns, or oscillators that align with the trap scenario. Step 11, Risk Management. Once you've confirmed the liquidity trap, it's time to execute your trade with appropriate risk management measures, including setting a stop loss and profit target. Step 12, Trade Execution. Enter your trade in the direction opposite to the false breakout created by the liquidity trap. For example, if you confirmed a short liquidity trap, consider entering a long trade to profit from the expected reversal. These 12 steps provide a detailed process for confirming liquidity traps using real-world examples and metrics like percentage movement and volume analysis. Remember that liquidity traps can be powerful reversal signals in scalping but require careful observation and quick execution. 4. Monitoring order book. Actively monitor the order book, focusing your attention on the key price levels you've identified. The order book displays a list of buy and sell orders at various price levels. Pay particular attention to the size of orders and how they change over time. 1. Order book analysis. Step 1. Start by selecting a reliable trading platform that provides access to real-time order book data. Ensure you have a clear view of the buy and sell orders at various price levels. Step 2. Identify key support and resistance levels on your price chart where breakouts are anticipated. These levels can be based on previous swing highs and lows, trend lines, or other technical analysis tools. Step 3. Continuously monitor the order book as the price approaches these breakout levels. Look for significant changes in order quantity near these levels. A rapid increase in sell orders near resistance or buy orders near support can indicate a potential false breakout. Step 4. If you observe a notable shift in the order book, assess it alongside other technical and fundamental factors. If the shift aligns with your analysis and suggests a false breakout, consider entering a trade in the opposite direction, aiming for a quick scalping opportunity. 2. Depth of market DOM data. Step 1. Utilize a trading platform that provides access to DOM data, which displays the current orders at various price levels. Ensure you're comfortable navigating this data interface. Step 2. Identify key support and resistance levels on your price chart, as these are the areas where breakouts are more likely to occur. These levels should be based on solid technical analysis. Step 3. Pay close attention to the DOM data as the price approaches your breakout levels. Look for imbalances in the number of buy and sell orders. A sudden change from an imbalance to a more balanced DOM can indicate a false breakout. Step 4. Confirm any observations from DOM data with other technical indicators or patterns. If everything aligns, consider entering a trade in the opposite direction of the breakout, aiming for a quick scalp as the price reverts. Let's dive into each of these liquidity patterns in more detail with examples. 1. Liquidity trap. Description: a liquidity trap involves placing a stack of orders just above or below a key support or resistance level to attract traders. Prices touch these orders briefly and then reverse. Example: imagine a stock trading at 50 with a strong resistance level at 51. Traders place a significant number of sell orders at 51, creating a liquidity trap. The stock briefly touches 51 but quickly reverses as these orders are triggered. 2. Order book white space. Description: order book white space occurs when there are significant gaps in the order book at specific price levels, indicating a lack of substantial support or resistance. Example: on a cryptocurrency exchange, you notice that the order book for Bitcoin has a gap between 40,000 and 42,000, with very few orders. This white space suggests that price movements in this range may be prone to false breakouts. 3. Flashing orders. Description: traders place and quickly cancel large market orders, causing temporary spikes in liquidity that can mislead others. Example: a trader submits a market buy order for 1,000 shares of a stock. Within seconds, they cancel the order. This action briefly increases buying interest, but when the order is cancelled, the price reverts. 4. Hidden iceberg orders. Description: hidden iceberg orders are large orders hidden within the order book. As smaller visible orders are executed, the hidden order is gradually revealed. Example: in a futures market, a trader places a hidden buy order for 500 contracts. As the market sells 50 contracts at a time, the hidden order is slowly exposed, creating the illusion of strong buying interest. 5. Layered orders. Description: traders place orders at different price levels, creating layers of liquidity. These orders may be removed as the price approaches, causing reversals. Example: in a forex market, there are multiple layers of buy orders at decreasing price levels below a key support area. Traders remove these orders when the price gets close to the support, leading to a sharp reversal. 6. Rapid order cancellations. Description: a sudden withdrawal of multiple orders in the order book can signal a loss of confidence in a price direction, leading to a false breakout. Example: in a stock market, several traders cancel their buy orders placed just above a resistance level at 60. This abrupt cancellation may precede a false breakout beyond 60 before a reversal. 7. Order clusters. Description: an order cluster refers to a group of orders at a specific price level, indicating a strong area of support or resistance. However, this can be manipulated for fake breakouts. Example: traders place numerous sell orders at 75 for a cryptocurrency, creating an order cluster. Some of these traders then quickly remove their orders, causing a temporary breakout above 75 before a reversal. 8. Revenge orders. Description: traders who had their stop-loss orders hit may place orders in the opposite direction to seek revenge on the market, causing temporary price reversals. Example: after their stop-loss orders are triggered in a forex trade, traders place multiple buy orders in revenge. This sudden buying pressure leads to a short-term reversal before the original trend resumes. 9. Low volume breakout. Description: if a breakout occurs on low trading volume, it can be a sign of a false move. Genuine breakouts are often accompanied by higher trading volumes. Example: in a stock market, a price breaks above a key resistance level on very low trading volume. This lack of participation suggests a potential false breakout. 10. Sudden stop hunting. Description: Large players may briefly push prices beyond key support or resistance levels to trigger stop-loss orders, causing a false breakout before reversing. Example, in a commodities market, the price of gold briefly drops below a significant support level at 1,800 to trigger stop-loss orders placed by retail traders. After triggering the stops, the price quickly reverses and moves higher. These examples illustrate how each liquidity pattern can manifest in real trading scenarios, potentially leading to false breakouts. Traders should be aware of these patterns and use them in conjunction with other analysis tools to make informed trading decisions. 3. Volume Profile. Step 1. Set up your trading platform to include volume profile indicators, which display trading volume at different price levels. Customize the settings to match your preferred time frame. Step 2. Identify key support and resistance levels on your price chart where breakouts are expected. These levels should be based on solid technical analysis. Step 3. Pay close attention to the volume profile as the price approaches these breakout levels. Look for the highest volume concentration, often referred to as the point of control POC. If the POC is near your breakout level and the price reverses quickly, it could indicate a false breakout. Step 4. Validate your observations from the volume profile with other technical indicators or patterns. If they confirm a false breakout, consider entering a trade against the breakout direction, aiming for a scalping opportunity as the price reverts to the mean. 4. Liquidity traps. Step 1. Familiarize yourself with the concept of liquidity traps, where large orders are positioned above or below key support or resistance levels to attract traders. Step 2. Identify potential liquidity traps on your price chart. These are often characterized by visible stacks of orders placed strategically near breakout levels. Step 3. Monitor how the price interacts with these visible order stacks. If the price briefly touches the trap and then reverses, it could suggest a false breakout designed to trigger stops. Step 4. Use additional technical indicators, such as candlestick patterns or volume analysis, to confirm the false breakout. If everything aligns, consider entering a trade in the opposite direction, aiming for a quick scalping profit. This breakdown provides more technical insight into the first 4 order flow-based tactics for detecting and confirming false breakouts. Each step emphasizes the importance of comprehensive data analysis and technical confirmation to make informed scalping decisions. 5. Identify market maker activity. Market makers can often be recognized by their continuous quoting. They frequently adjust their buy and sell prices to reflect changes in market conditions. Observe the order book for traders who consistently provide liquidity by maintaining a tight spread, and watch for their responses to market events. Here are 10 techniques to identify market maker activity. A continuous quoting. Market makers consistently provide buy and sell quotes, frequently updating their prices to adapt to changing market conditions. Look for traders who maintain a constant presence in the order book by quoting prices on both sides of the market. B. Tight spread maintenance. Market makers aim to profit from the bid-ask spread. They typically keep the spread tight, which means the difference between their buy bid and sell ask prices is minimal. If you see a trader consistently offering a narrow spread, it's a sign of potential market-making activity. C. Quick response to market events. Market makers react swiftly to market events, adjusting their quotes to accommodate changing supply and demand dynamics. Observe how traders respond to news releases, economic events, or sudden price movements. Market makers are likely to adjust their quotes in real time. D. High trade frequency. Market makers engage in a high volume of trades, often executing numerous small orders. Look for traders who frequently enter and exit positions throughout the trading day. Their activity can be indicative of market-making strategies. Volume concentration at specific levels. Market makers may accumulate a substantial volume of orders at specific price levels, both above and below the current market price. These levels are often referred to as resting orders and can be identified by a concentration of limit orders in the order book. Consistent spacing of orders. Market makers often place orders at regular intervals within the order book. You may notice a pattern where their orders are evenly spaced apart. This spacing is a deliberate strategy to maintain liquidity. Minimal overnight positions. Market makers typically avoid holding positions overnight. They aim to have a balanced book, which means they want to be neither net long nor net short at the end of the trading day. Observing traders who consistently close their positions before the market closes can be a clue. Active during high volume periods. Market makers tend to be most active during periods of high trading volume when liquidity is in demand. Monitor their activity during peak trading hours or when major economic announcements are scheduled. Order cancellations. Market makers frequently modify or cancel their orders in response to changing market conditions. Watch for traders who frequently cancel and replace their orders in the order book. Examine historical data. Analyze historical order book data to identify consistent patterns of order placement and cancellations. You can use specialized software or tools to visualize order book activity over time and spot market maker behavior. Remember that identifying market maker activity is not always straightforward, as some traders may employ similar strategies. Therefore, it's essential to combine multiple techniques and consider the context of the market to make more accurate assessments of market maker involvement. 6. Entry signal. An entry signal is generated when you see a significant market maker order or detect activity suggesting a price move is imminent. For example, if a market maker suddenly tightens the spread, this can be a signal that they anticipate a price movement. This can be a prompt to enter a trade. Here's a scalping strategy based on volume price impact VPI. Volume price impact VPI scalping strategy. Objective: this strategy aims to capitalize on short-term price movements driven by significant volume spikes. Indicators needed. Volume indicator, to monitor trading volume on a tick-by-tick or time-based basis. Price chart, candlestick or bar chart for price movements. Trading rules. Volume surge, monitor the trading volume closely. Look for a significant surge in volume compared to recent historical volume data. This volume surge is a key trigger for this strategy. Price confirmation, confirm the volume surge with a corresponding price movement. For example, if the volume surge is accompanied by a sharp upward price movement, this suggests bullish momentum. Entry, enter a trade in the direction of the price movement associated with the volume surge. For example, if the volume surged with a price increase, consider a long buy position. Trade size, determine your trade size based on your risk management strategy. Be prepared to take a smaller position size for scalping, as these are short-term trades. Stop loss, set a tight stop loss to limit potential losses. This stop loss can be placed just below the recent low for long trades or above the recent high for short trades. Take profit, determine a quick profit target based on your risk-reward ratio and market conditions. Scalpers often aim for a small number of pips or ticks. Trailing stop, consider using a trailing stop to lock in profits as the trade moves in your favor. This can help capture additional gains if the price continues to move in the desired direction. Exit, exit the trade when your profit target is reached, or if the price shows signs of reversing against your position. Risk management, apply proper risk management techniques. Only risk a small percentage of your trading capital on each trade. Calculate your position size based on the distance between your entry and stop loss. Continuous monitoring. Scalping requires continuous monitoring of the volume and price movements. Be alert for any changes in volume patterns or price behavior that could signal a reversal or change in market sentiment. Notes: VPI scalping focuses on capturing short-term price movements following volume surges. It's essential to act quickly and decisively when the conditions align. Avoid trading during periods of low volume, as these can lead to erratic price movements with false signals. Always backtest this strategy with historical data and practice it on a demo account before implementing it in live trading. Adapt the strategy parameters to fit your risk tolerance and preferred trading instruments. As with any trading strategy, there are risks involved. Never trade with more capital than you can afford to lose, and consider seeking advice from a financial professional if you're new to trading. 7. Trade direction. Determine the direction of your trade based on market maker activity and order book dynamics. If market makers are aggressively buying, it might indicate strong bullish sentiment, suggesting you should consider going long. Conversely, if they are aggressively selling, it could be a signal to go short. Here are trade conditions based on order flow, bid-ask spread, order book, market depth data, and tick-by-tick volume. 1. Imbalance in order flow. Condition: look for a significant imbalance in order flow, where buy orders substantially outnumber sell orders or vice versa. Trade action: consider entering a trade in the direction of the dominant order flow, expecting short-term price movement. 2. Tightening bid-ask spread. Condition: monitor the bid-ask spread for signs of tightening, where the spread narrows significantly. Trade action: enter a trade when the spread tightens beyond a predefined threshold, anticipating increased liquidity and potential price movement. 3. Large orders in order book. Condition: identify substantial buy or sell orders in the order book, often referred to as iceberg orders. Trade action: trade alongside these large orders, expecting price movement as they are executed. 4. Depth of market data. Condition: analyze the depth of market DOM data to spot significant clusters of orders at specific price levels. Trade action: enter a trade when there is a dense concentration of orders at a particular level, anticipating that this level will act as a support or resistance. 5. Tick-by-tick volume surge. Condition: watch for a sudden surge in trading volume on a tick-by-tick basis. Trade action: enter a trade when a significant volume spike occurs, expecting increased market activity and potential price movement. 6. Bid-ask ratio. Condition: calculate the ratio of the number of buy orders to sell orders in the order book. Trade action: trade in the direction of the dominant side buy if buy orders significantly outnumber sell orders, and vice versa. 7. Order book delta. Condition: calculate the difference between the volume of buy orders and sell orders at specific price levels in the order book. Trade action: enter a trade when the order book delta shows a substantial imbalance, anticipating price movement. 8. Bid-ask spread expansion. Condition: observe instances where the bid-ask spread suddenly widens. Trade action: enter a trade when the spread expands, expecting potential volatility and a price move. 9. Order flow velocity. Condition: analyze the speed at which orders are being executed, especially market orders. Trade action: trade in the direction of the dominant side of rapid order flow. 10. Cumulative volume profile. Condition: calculate the cumulative volume traded at each price level. Trade action: look for areas of high cumulative volume as potential support or resistance zones and trade accordingly. These trade conditions are designed to leverage the information available from order flow, the bid-ask spread, order book data, market depth, and tick-by-tick volume to make informed trading decisions. However, it's crucial to thoroughly backtest and practice these conditions in a demo environment before implementing them in live trading. Additionally, always incorporate risk management techniques to protect your capital. 8. Risk management. Robust risk management is critical. Establish a tight stop loss just beyond the point where your trade thesis would be invalidated. For instance, if you entered a long position based on market maker activity, set your stop loss slightly below the level where they have been providing liquidity. Here's the detailed explanation of the relationship between liquidity and price movements. High liquidity support resistance. Support and resistance. Support levels are areas where buying demand is traditionally strong, and resistance levels are areas where selling supply is considered significant. These levels are often formed at prices where significant transactions have occurred in the past. Insight: when price approaches a support or resistance level, its reaction can vary depending on the liquidity present at those levels. High liquidity at these levels may mean many buy or sell orders are placed, leading to rebounds, consolidations, or trend reversals. In other words, prices can react strongly to support and resistance levels due to high liquidity. Low liquidity gap. Liquidity gap. A liquidity gap occurs when there's a significant gap between the current price and the next level of liquidity. This often happens when buy or sell orders are scarce, creating a zone with minimal resistance to price movements. Insight: when price reaches a low liquidity zone, it can move more rapidly and with greater volatility because there are fewer orders to counteract the movement. However, it's important to note that price movements in low liquidity zones are often short-lived and can be challenging to predict. Traders should exercise caution and use stop orders to manage risks in such situations. Market context. Trend or range. The relationship between liquidity and price can also depend on the market context. In a strong trend, prices can often break through support and resistance levels relatively easily as traders follow the dominant trend. Conversely, in a ranging market, support and resistance levels are more likely to hold prices due to the presence of liquidity. External factors. News and events. Economic announcements, significant news, and geopolitical events can swiftly change the dynamics of liquidity and prices. Large buy or sell orders can be triggered in response to such news, altering price directions. In summary, the relationship between liquidity and price movements is intricate and contingent on numerous factors. Support and resistance levels with high liquidity tend to draw traders' attention and can influence price movements. However, low liquidity zones can facilitate swift and volatile price movements. Traders should consider these factors and employ technical and fundamental analysis to anticipate price movements. Risk management remains crucial regardless of liquidity context. 9. Take profit and exit. Set a predefined profit target based on your risk-reward ratio. Scalpers often aim for small, quick gains. Exit the trade when your profit target is reached or when you see signs that market maker activity is shifting against your position. For example, if market makers start widening the spread, it could signal a change in sentiment. In terms of money management, there's a trade-off between the width of your take profit and stop loss levels, the percentage of winning trades, and the precision of your entry and exit points. Here's how to approach this issue. 1. Short take profit and wide stop loss. Objective: this approach aims for quick, small gains with a high win rate. Pros: higher percentage of winning trades. Quick realization of profits. Cons: risk-reward ratio is typically less favorable. Slippage and transaction costs can impact overall returns. Money management strategy. Allocate a smaller portion of your capital to each trade due to the lower potential profit. Use this approach when you have a strong edge in identifying short-term price movements. Implement strict risk management by setting stop losses at a safe distance to protect against larger losses if the trade goes against you. Too long take profit and short stop loss. Objective: this approach aims for larger profits with a lower win rate. Pros: the potential for larger gains on winning trades. Fewer constraints on entry and exit precision. Cons: lower percentage of winning trades. Requires careful timing and precise entry-exit points to minimize losses. Money management strategy. Allocate a relatively larger portion of your capital to each trade due to the potential for larger profits. Employ this strategy when you have confidence in identifying significant price movements. Pay close attention to your timing and entry-exit points to maximize the chances of hitting your long-term profit targets. Balancing act. Finding the right balance between take profit and stop loss levels depends on your trading style, risk tolerance, and the market conditions you're trading in. Consider a mixed approach where you have a core strategy with a moderate risk-reward ratio and a higher win rate. This can provide stability to your overall trading results. Use techniques like trailing stops to capture larger profits while allowing winners to run. Always prioritize risk management. Determine how much capital you're willing to risk on each trade, and adjust your position size accordingly. In essence, there's no one-size-fits-all money management strategy. The choice between short or long take profit and stop loss levels depends on your trading objectives and your ability to identify and time market movements accurately. Regardless of your strategy, rigorous risk management should remain a constant priority to protect your capital. 10. Continuous monitoring. Scalping requires continuous vigilance. Stay engaged, monitor market maker activity, observe order book changes, and keep an eye on any relevant news or events. Be prepared to adjust your position or exit quickly if conditions change. By meticulously following each of these steps, traders can employ the market making and volume price impact scalping strategy to potentially capitalize on market maker behavior and price impact from large orders. Nevertheless, it's crucial to practice this strategy thoroughly on a demo account before using real capital and to adjust it to your risk tolerance and trading style. Mastering your trading frequency is crucial, particularly when engaging in high leverage scalping. It's essential to control and keep your trading frequency at a moderate to low level. Here's the additional information in English. Controlling trading frequency for high leverage scalping. Frequency management, one critical aspect of successful high leverage scalping, especially when employing a strategy with a high win rate and small profit targets, is controlling your trading frequency. Why control trading frequency? Risk management. High leverage scalping can magnify both gains and losses. Trading too frequently can lead to overexposure and higher risk, especially when market conditions are less predictable. Psychological stress. Frequent trading can be mentally exhausting and emotionally draining. Maintaining a high level of focus and discipline for extended periods can lead to trader burnout. Market noise. Intraday price movements can often be noisy and unpredictable. Frequent trading may expose you to market noise, resulting in more false signals and increased transaction costs. Moderate to low frequency. To address these challenges, aim for moderate to low trading frequency when scalping with high leverage. Here's how. 1. Set daily or weekly limits. Establish limits on the number of trades you'll execute per day or week. This prevents overtrading and helps you stay within your risk tolerance. 2. Focus on quality over quantity. Instead of trading excessively, prioritize the quality of your setups. Wait for high probability setups with clear signals and favorable risk-reward ratios. 3. Review and reflect. After each trading session, review your trades and performance. Identify areas for improvement, assess whether you stuck to your frequency plan, and adjust if necessary. 4. Use trading plans. Develop a trading plan that outlines your entry and exit criteria, including the frequency at which you'll trade. Stick to your plan religiously. 5. Avoid revenge trading. If you incur losses or hit your daily or weekly limit, resist the temptation to engage in revenge trading. Emotional decisions can lead to further losses. 6. Diversify strategies. Instead of relying solely on high leverage scalping, consider diversifying your trading strategies. This can help spread risk and provide opportunities in different market conditions. 7. Prioritize self-care. Scalping requires intense focus. Prioritize self-care, including taking breaks, staying hydrated, and managing stress to maintain peak performance. Remember, trading frequency should align with your risk tolerance, strategy, and overall trading goals. Control overtrading by adhering to your plan and prioritizing quality setups over quantity. In the fast-paced world of high-leverage scalping, discipline and a well-thought-out approach are your keys to success.